Right, good day. This is Dr. Kenneth Ta. Today we want to consider Chapter 2. Chapter 2 is Investing and Financing Decision and the Accounting System. In Chapter 1, we discuss different types of transactions or decisions that takes place in a company. We spoke about operating activity, investing activity, and financing activity. We will look at the effect of operating activity on the accounting system later on. In this chapter, we just want to focus on effects, investing and financing decision on the accounting system, how these decisions are going to affect the recording of information in the accounting system, and how ultimately we develop the balance sheet or the financial statement. We need to understand the business. We understand the amount appearing on the company's balance sheet by answering the following question. What business activity cause changes in the balance sheet? How do specific activities affect each balance? And how do companies track the balance sheet amount? So the bigger question is the final figures that we have on the balance sheet. How do we arrive at those figures? What are the activities that occur in the business that results in the figures we have on the balance sheet? The elements of the balance sheet that we had discussed before include assets, liabilities, and stockholders' equity. And this is what we call the balance sheet or the accounting equation. We have said this equation needs to always stand true. It needs to balance. Asset needs to be equivalent to liabilities plus stockholders' equity. We define assets as economic resources. They are economic resources. In other words, they have future benefits for the company. And liabilities are debts or obligations. So they are debts or obligations. We also have what we call stockholders' equity, which is financing that is provided by the owners. So the balance sheet equation suggests again the asset needs to be equivalent to liabilities plus stockholders' equity. This is a sample of the balance sheet equation, and this is for Chipotle Mexican Grill. This is a consolidated balance sheet, which means that it takes all subsidiary into consideration. The balance sheet is at December 31st, 2011. The balance sheet is usually a snapshot of the company's performance at a particular point in time. So this will be the company's performance as at this date. When we develop the balance sheet, we usually have assets, and below the assets we are going to have liabilities and stockholders' equity. When we record the assets, we usually start with the current assets, and then we have the non-current assets. On the liabilities side, we do the same. We start with the current liabilities, and then we write the non-current liabilities. And below the liabilities, we have the stockholders' equity accounts, and the different accounts are common stock, additional paid-in capital, and retained earnings. So that is the balance sheet. We always will find that the assets will be equivalent with total liabilities and stockholders' equity. So the balance sheet equation needs to always hold true. What business activities cause changes in the financial statement amount? So in this lesson, we really want to understand how we arrive at the figures, the numbers that we have on the balance sheet, and what are the business activities that result in changes in the financial statement amount. How do we get to this number? We need to know the nature of business transactions. There are different kinds of transactions. We have what we call external events. External events, they are exchanges between entity and one or other party. In other words, is simply an exchange between a company and another company, or a business and another business. Example could be the buying of machine from a supplier. So notice that two businesses are involved. The buying of machine, one company is buying and the other company is selling. The supplier is selling. So that is an external event. It's going to affect the transaction of the company. We also have internal event. Internal event, they are events that are not exchanged between parties, but they have a direct and measurable effect on that particular entity. Example could be using up insurance prepaid in advance. Using up insurance prepaid in advance. So this is a business activity that is internal. It's not between two businesses. When we record transactions that happen in a company, we want to understand accounts. Accounts are usually organized formats that are used by the company to accumulate the dollar effects of a transaction. So when there are changes in the company's cash, that will be reflected on the cash account. Changes in the company's inventory will be reflected on the inventory account. So we want to know different accounts which are organized format that are used to show the effect, the dollar effect of a transaction. So we also have equipment account, note payable accounts, etc., etc. These are typical account titles. Here they are classified based on the broad category of asset, liabilities, stockholders' equity, revenue, and expenses. So for assets, again, assets have economic benefits, they're economic resources that have future benefits. These are the different types of asset accounts. We have cash. Cash is an asset, it has benefit. Future benefit is an asset. We have short-term investment, that is an asset. We have accounts receivable, notes receivable. These are assets. Receivables usually represent amount that are owed. They are owed by customers or other types of businesses. In other words, when a company sell an account, say a business sell to another business and receive a promise to pay, that is a note receivable, a note that has been signed and say we are going to pay. So this business is expecting payment in future. So when one business is expecting payment in future, that could be a note receivable or an account receivable. Inventory is also an asset. Supplies are asset. Prepaid expenses. Prepaid expenses are asset. The company pays and they expect service or benefit in the future. It could be prepaid bill, prepaid rents, prepaid salary. Those are all assets. Then we have long-term investments and asset, equipment, building, land, intangible assets. Those are different asset accounts. We also have liability accounts, account payable. Accounts payable is really like the reverse of accounts receivable. So with accounts receivable, the company sells on account. So somebody is owing the company. With accounts payable, the company is owing somebody. So the company buys on account. The company buys with a promise to pay. So that is a liability. That is a debt that needs to be settled in future. So the company will record it as accounts payable. There is accrued expense payable, an expense that was supposed to happen, but it has been pushed down the road. That is a liability. Note payable is a liability. Taxes payable is a liability. Instead of making cash payment, the company issue a note that is a promise to pay in the future. That is not payable, it's a liability. Taxes are due, but it is pushed down into the future. That's taxes payable. We also have unearned revenue. Unearned revenue is simple. When a business pay for a business receive payment for services that will be rendered, services that will be rendered, or goods that will be delivered sometime in the future. That is unearned revenue. So it is revenue, but it has not yet been earned. That is a liability to the company. Bonds payable, those are liabilities. Then we have stockholders' equity accounts. We have contributed capital, which is an additional amount of money that shareholders contribute into the business. We have retained earnings, which is the earnings that has been made by the business, but instead of engaging distribution through dividend, the company retains that money. They keep that money into the business. That is retained earnings. We also have different revenue accounts. This is how the company gets money. It could be through sales, fees, interest, rent, services offered. So the money that comes in will have different accounts. It could be sales revenue, fees revenue, interest revenue, rent revenue, service revenue. Then there are expenses. Expenses. Money is going out. The company is spending for the business to run. Cost of goods sold. Cost of goods sold is an expense. Wages expense. Rent expense. When the company pays interest, interest expense. Depreciation expense. The company pays for advertisement, advertising expense. The company pays insurance, insurance expense. Repair expense, income tax expense. Those are different expense accounts. So these are typical account titles. Principles of transaction analysis. So when we need to record the transaction of a business, we need to have those core principles in mind. The first one is that every transaction affects at least two accounts. So we call that the duality of effect. Every transaction that occurs in the business will always affect at least, take note of that word, at least two accounts. It could be three, it could be four, it could be more, but transactions will always affect at least two accounts. The next principle we need to also keep in mind is that the accounting equation must remain balanced after each transaction. After each transaction, we need to ensure that assets is equivalent to liabilities plus stockholders' equity. Balancing the accounting equation, we need to ask ourselves what was received and what was given. So we need to identify the accounts and be able to record the changes that are taking place in the account. We need to also verify if the accounting equation remains the same, if the accounting equation balance. So after we identify and record those the transaction based on the different accounts, we need to ensure that the accounting or the balance sheet equation balance. Assets should always be equivalent to liabilities plus stockholders' equity. We are going to go through a couple of examples, a couple of transactions, and we'll see the accounts that are affected and how we record those transactions. And then we'll need to also ensure that the balance sheet equation remain balanced. So the first example we want to look at is example A. It says Chipotle issued 10,000 additional shares of common stock, $0.01 per value per share, and they receive 62,300 in cash from investors. So this is a transaction that occurs. So we ask ourselves that based on this transaction, what are the different accounts that are affected and how are they affected? So clearly we can see that cash account is affected because this transaction says the company issue additional shares of common stock and they receive 62,300 in cash. So what is being received? So cash is an asset account. So asset is increasing by 62,300 by 62,300. Also, common stock is also being affected. Common stock is being affected. Common stock is increasing. Common stock is a stockholders equity account. It is increasing by $100. How do we arrive at the $100? We have 10,000 shares. So we take 10,000 shares and we multiply it by 0.01 dollar per share. So that gives us $10. So that is an increase. But what the company received as cash was $62,300. It implies that the other money came in as additional paid in capital. Additional paid in capital. So if we take this cash receipt minus the common stock, we end up with 62,200, which is additional paid in capital. So this transaction A, Chipotle issued 10,000 additional shares of common stock, receiving $62,300 in cash from investors. Is going to affect three accounts. So it's going to affect the cash account, the common stock account is also affected, and the additional paid in capital is also affected. Cash is an asset account, is increasing. Common stock is a stockholders equity account, is increasing. Additional paid in capital is a stockholders equity account, is also increasing. So when we come to the balance sheet equation, we see cash is increasing. So asset is increasing by 62,300. We come to the right hand side of the equation. We see common stock increases by 100 and additional paid in capital is increasing by 62,200. So when we add this up, what we find is that the left hand side of the balance sheet equation is equivalent to the right hand side of the balance sheet equation. So the balance sheet balances, the balance sheet equation balances. All right, we look at the second transaction. It says Chipotle borrowed $2,000 from its local bank, signing a note to be paid in 3 years. So again, what accounts are being affected? Cash, of course, is being affected because cash account is being affected. Cash is coming into the company. Cash is an asset. So what is received is cash. Cash is an asset. Cash is increasing by $2,000. The company borrowed and they signed a note, a promise to pay. So note payable is also being affected. Note payable is a liability. So liability is increasing. So plus L, liability is increasing by $2,000. So we can clearly see that from transaction B, the two accounts that are affected are cash and note payable. Then we ask ourselves, does the balance sheet equation remains balanced? The answer, of course, is yes. Cash is increasing, asset is increasing by 2,000, liability, precisely note payable, is increasing by 2,000. So when we sum up the right-hand side of the accounting equation, we end up with 62,300 plus 2,000. It's actually equivalent to the left side of the balance sheet equation when we sum up the assets. So this is equivalent. So the balance sheet equation balances. We also look at the second transaction, the third transaction. It says Chipotle bought new ovens, counters, refrigerators, and other equipment costing 63,100, but they paid 55,100 in cash and signed a note for the rest. So what are the accounts that are affected? So clearly property and equipment is being affected. Property and equipment account is increasing. Those are assets. So property and equipment will include the new ovens, the counter, the refrigerators, and other equipment, and the value is 63,100. So asset is increasing by 63,100. At the same time, asset is also reducing. What asset? Cash. The company paid cash 55,100. So cash is reducing by 55,100. But there is also another account that is affected, notes payable. So the balance between this equipment that came in and the cash that was paid is 800, and that is the amount that the company makes a promise to pay. So they sign a note, which is a promise to pay. So that is notes payable. So the three accounts that are affected by transaction C, again, property and equipment account, cash account, notes payable account. We bring all of them in the balance sheet equation. Cash is reducing, asset cash is reducing by 55,100. Asset, property, and equipment is increasing by 63,100. And then on the right hand side of the balance sheet equation, liability is increasing by 800. So when we add and subtract everything on the left hand side and add and subtract everything on the right hand side, what we find is that the balance sheet equation is going to balance. It's going to balance. Another transaction we want to look at is transaction D. Transaction D says Chipotle paid 4,400 to the local bank on the amount borrowed in B above. So we ignore interest. So the company is making a payment on the notes payable that they had promised when they incur a debt. So what are the two accounts that are being affected? Of course, the notes payable account will be affected. It's going to reduce. The note payable account is a liability. So when the company is paying 400 in cash, their liability is going to reduce. So liability is reducing by 400. And cash, which is an asset, is also reducing by 400. So those are the two accounts that will be affected, notes payable and cash. We bring all of that on the balance sheet equation. Cash is reducing by 400. Liability is reducing by 400. Accordingly, the balance sheet equation balances. Another transaction we want to look at, transaction E. It says Chipotle bought the stock of other companies, paying 60,400 in cash. It says the company intends to hold 20,900 of the stock as long-term investment and the rest as short-term investment. So in other words, the company is paying for a certain long-term and short-term investment. What are the accounts that are being affected? Payment is being made cash. So cash is being affected. The cash account is going to be reduced. So cash is an asset. So asset is decreasing by 60,400. So this is the amount of money that is going out. Two other asset accounts are being affected. Short-term investment is increasing and long-term investment is also increasing. So we are told that the company intends to hold 20,900 in long-term investment. So if the company is paying 60,400 minus the 20,900, the balance is 39,500. That will be the amount the company is going to hold in short-term investment. So the three accounts that are affected by transaction E, they are the short-term investment, the long-term investments account, and the cash account. If we bring everything on the balance sheet, what we find is that cash is reducing, short-term investment is increasing, long-term investment is increasing. When we sum this up, it is zero, and there is no change on the right side of the balance sheet equation. So the balance sheet equation balances. The last transaction we want to look at is transaction F. Transaction F says Chipotle does not pay dividend, but instead reinvest profit into growing the business. However, for illustration purposes, assume that Chipotle board of directors declare that the company will pay $3,000 in cash as dividend to shareholders next quarter. So if the company declares dividend, they promise to pay dividend of $3,000. What are the accounts that are being affected? Two accounts are being affected. Retained earnings is going to reduce. Retained earnings is a stockholders' equity account. Money is going to come out from retained earnings as distribution to shareholders, dividend distribution. So retained earnings is going to be affected, and dividend payable is also going to be affected. The company promised to pay dividend in the next quarter, so that is dividend payable, which is a liability. So liability is increasing by $3,000, and retained earnings, which is an equity account, is decreasing by $3,000. So those are the two accounts that will be affected. If we bring those into the balance sheet, we see that liability is increasing, but at the same time retained earnings is reducing. So the right hand of the balance sheet equation is going to cancel out when we sum all of this. So at the end, the balance sheet equation balances. In other words, asset is equivalent to liabilities plus stockholders' equity. So when transactions occur in businesses, those transactions are usually analyzed, and they are recorded in the journal entry, and then they are posted in the general ledger. From the general ledger, we use to build the financial statement. So at the end will be the final product of the financial statement. So again, when transaction occurs in the business, they are recorded in the general ledger. They are recorded chronologically. They are recorded based on how they occur on the general ledger. And then they are posted in the general ledger. Let me say this again. When transaction occurs in the business, they are recorded in the general journal. And in the journal, they are recorded chronologically based on how they occur, and then they are posted in the general ledger. And in the general ledger, we follow what we call the T account, which is a way of doing posting to show how that transaction affects each account. So the specific accounts that we identify, will be able to record that transaction to show how the account is going to change. And of course, at the end, the balance sheet equation should always remain the same. Transaction analysis model. So when we post into the general ledger, the T account is merely a short form or a shorthand term for the entire ledger account. The T account has two sides. It has the left side and it has the right side. The left side is called debit and the right side is called credit. So there is no deeper meaning to this but for just saying we have the name of the account, and the left side is what we call the debit and the right side is what we call the credit. In recording accounts or in posting accounts on the general ledger or the T accounts, these are the rules we use. This is very important. We will say that asset accounts have a debit balance, which implies that increase in asset account is recorded on the debit side or the left side of the T account. What we also see is that liability accounts have a credit balance, and stockholder equity account also have a credit balance. So whether it is common stock or additional paid in capital or retained earnings, they all have a credit account. So what that implies is that increases in liabilities are recorded on the credit side or the right hand side. Increases in common stock are recorded on the credit side. Increases in retained earnings are recorded on the credit side. So the way we say it is that assets have a debit balance. Asset accounts have debit balances, which implies that increases in assets are written on the debit side. Liability accounts have credit balances. Stockholders' equity accounts have credit balances, which implies that increases in the stockholders' equity account are recorded on the credit side of the T account. So let's look at the first transaction that we had discussed, transaction A. Transaction A, we said there are three accounts that are affected: the cash account, the common stock account, and additional paid-in account. Usually we will write this first starting with the account that has a debit balance. So cash has a debit balance, so we'll start with cash. We'll put the amount 62,300, and then common stock and additional paid in. These are both equity accounts and they have a credit balance. So increases in equity account receive a credit balance. So we'll put them under the credit side. So this is really how we record these transactions in the journal entry. Once we have them in the journal entry, the next thing we do is to post them to the general ledger, and they come in the form of a T account. So you see we are taking them from the general ledger where we have cash has a debit balance, common stock and additional paid in have a credit balance. So when we post them now from the general journal to the general ledger, in the ledger we are posting on T accounts for different accounts that are affected. So in that first transaction we had cash account, common stock account, additional paid in account. So when we come to cash, cash is increasing based on transaction A. So it has a debit balance because assets have debit balance. Common stock is increasing. Additional paid in capital is increasing. These are both equity account. Equity increases have a credit balance. So they all come on the credit side of their respective T accounts. So this is the cash that was there before plus the additional cash. It brings the amount to this. This was a common stock amount that was there before plus the additional common stock brings the common stock to this amount. And in like manner, 372,200 was there before as additional paid in capital plus 62,200 that came in, now increasing the additional paid in capital to 430 34,400. So what is important here is for us to understand that when transaction occurs, transactions are recorded in the general ledger. They are recorded chronologically based on how they occur, and then we post them into the general ledger. In the general ledger, the posting is a kind of T account, T form, T account. In the T account, assets account take a debit balance, and liabilities and stockholders equity account takes a credit balance. So again, this is a sample of the T account standing on its own. There's an increase in asset, it takes a debit balance. This is the common stock standing on its own. There is an increase in common stock, it takes a credit balance. So this is the example A that we considered. Again, in recording example A, these are the three accounts that we identify. We write the cash, which is an asset account taking a debit balance. We indent common stock and additional paid in. They all take credit balance. And then we move what we have to the general ledger. On the general ledger, cash increases, again is going to take a debit balance, and common stock and additional pay in, which are stockholders equity account, their increases will take a credit balance. And of course, as we had discussed before, this transaction leaves the balance sheet balance. Every transaction that occurs, the balance sheet will always remain balanced. For transaction B, Chipotle borrowed 2,000 from his local bank, signing a note to be paid in 3 years. So the two accounts that we identified before that were affected, they were cash and notes payable. So they borrowed the money, so they received cash. Cash is an asset. Cash was increasing. Assets have a debit balance. So we'll start with the account that have a debit balance, which is cash, 2,000. Notes payable is a liability. Increases in liability takes a credit balance. So we'll indent it slightly from cash. We'll write it out. Note payable, liability is increasing, plus L, and that ends up with a credit balance. Then we had seen that the balance sheet equation balances. So there is an increase in the left-hand side, equivalent increase in the right-hand side. From the general journal, we post this transaction to the general ledger. So where we have each of these accounts standing on their own cash account and notes payable, the cash account is an asset, is increasing, so it takes a credit balance, so it comes on the credit side. Notes payable is a liability, so it comes on the debit side, on the credit side. So cash goes on the debit side, notes payable, the amount comes on the credit side because liabilities take a credit balance. So if we look at all the transactions that we discuss from transaction A to transaction F, we can actually place them on the general ledger, and we'll end up with something like this, where we have all the different accounts that were affected: cash, short-term investment, property and equipment, long-term investment, notes payable, dividend payable, common stock, additional paid in, and retained earnings. From the general ledger, the next thing businesses will do, they will build a trial balance. They will take the balances of those different accounts and they'll place them in this trial balance. So if there was a debit balance, it will end up on the debit side. The accounts that have credit balance, it will end up with the credit side. And on the trial balance, when we add up the debit and the credit side, they must always be equivalent. So permit me go back a little bit and I'll show you how this amount is coming from the general ledger, the cash account. So it is a debit balance. So if we go back, we will see cash. These are the changes in cash that are reflected on the general ledger, but we end up with a debit balance of 349,600. So 349,600. That is a debit balance. So we'll post this amount, we'll take this amount to the trial balance, and it will be on the debit side because it's coming from the debit side of cash. So we find that amount cash on the debit side. So the trial balance is a listing of all accounts in the general ledger. So the purpose of the trial balance is to make sure that debit and credit are equal before we prepare the balance sheet. So when we sum up all the debit and sum up all the credit, they are equal. And from this trial balance, we can now prepare the balance sheet. In preparing the balance sheet, we usually have what we call the classified balance sheet. In the classified balance sheet, the assets and the liabilities are recorded, but in two categories. We have what we call the current and the non-current. So current assets are those to be used or turned into cash within the upcoming year, whereas non-current assets are those that will last longer than 1 year, or those that will last longer than one accounting period. So in developing the balance sheet, we are going to write them based on current assets and then current liabilities. And in the liability side, we'll also state first current liabilities followed by non-current liabilities. Current liabilities are those obligations that the company intends to pay the following year. They'll be settled within the next 12 months. So those are current. The ones that will stay longer than 1 year will be non-current liabilities. So this is an example of the balance sheet, and this is really where we want to arrive. You see, we come now to cash, which is a current asset. We write the balance sheet. First, we must start with the company's name. We write the statement. There's a consolidated balance sheet. We have the measure, which is thousands of dollars, except per share data. So now for the year 2012, current assets will include cash, short-term investment, accounts receivable, supplies, prepaid expense. So when we add all of those, we end up with the total current asset. Then non-current asset will include things like property and equipment, long-term investment. When we add them with the total current asset, we have our total asset for the year 2012. For the date of the balance sheet 2012, because the balance sheet is a snapshot of the company's performance at a particular point in time. We come to the liability side. We record the liability based on current liabilities. So all current liabilities. And then the only non-current liability that this company has is notes payable. When we sum everything up, we end up with total liability. Then we have the stockholders' equity account that is made up of common stock, additional paid in, retained earnings. So all these numbers, if you notice, they are coming from the trial balance. So we are using the trial balance to build the balance sheet. And what we find with the balance sheet is that the accounting statement must always remain true. Total asset is actually equivalent to total liabilities plus stockholders' equity. We had mentioned before that in the United States, the financial statement is developed based on the generally acceptable accounting principles, which deviate significantly from the International Financial Reporting System. And what we find is that the format of the balance sheet will differ. In the GAAP system, the balance sheet, as we had mentioned, we need to have asset, then we'll list current and non-current asset. Then we have liabilities, current and non-current liabilities, and then we'll end up with stockholders' equity. For the International Financial Reporting System, the assets will rather be listed based on the non-current and then the current assets. And then the stockholders' equity will come first before the liability accounts. And under the liability accounts, the non-current liability will be written first before the current liability. So in terms of formatting, the GAAP system differs significantly from the International Financial Reporting System that is used by international companies abroad. Once we have the balance sheet, we can now use the balance sheet to make informed decision. We can compute ratios. One of the ratios we can compute from the numbers on the balance sheet is what we call the current ratio. This is actually a measure of liquidity. It's a measure of liquidity. It tells us how liquid the company is. If the company has enough current assets to pay off their current liabilities, So current ratio is current asset divided by current liability. And we want to compute this for 2011. So we'll go to the balance sheet statement and look for current assets and current liabilities. And then we take current asset divided by current liability. If you permit me to go back to the balance sheet, again, we are looking at the year 2011. So what we find, we are looking for total current asset. This is current asset 501, and then current liabilities. This is current liabilities 157,500. So that is what we are going to bring into this equation to compute the current asset, to compute the current ratio. So the current ratio again will be current asset divided by current liabilities, and that gives us 3.182. And this in general will be considered high because it's much more greater than 1. It's greater than 1. So what that suggests to us is that the company has enough current assets to pay off their current liabilities. So the company is good as far as liquidity is concerned. All right, so in this chapter, we have focused on investing and financing activity, and we have seen how that is going to affect the numbers that come on the financial statement. In future chapters, we'll focus on operating activity, but as a kind of summary, if we think about investing activity, we can see different investing activity: the buying of long-term asset and investment of cash. So when we buy long-term asset, cash is going out. So we can look at this in terms of cash inflow, which will be positive, and cash outflow, which will be negative. So when we buy, cash is going out, that is negative. Selling long-term assets, when we sell, money is coming in, so that is cash inflow, which is positive. Lending cash to others, when we lend, money is going out, so that will be cash outflow, which is negative. Receiving principal payment, we are receiving, money is coming in, that is positive, that is inflow. If we look at financing activity, borrowing cash from the bank, when we borrow, money is coming in, that is cash inflow. And if we go right down to the end, paying cash dividend. When we pay cash dividend, money is going out. That is cash outflow. That brings us to the end of chapter 2.